Good morning, everyone. Welcome to today's 1 Million by 1 Million online rendezvous. This is Sramana Mitra, founder and CEO of 1M by 1M, coming to you live from Silicon Valley, California. This session is live on LinkedIn, Facebook, and Twitter. So whichever platform you're joining from, welcome. And whichever country or time zone you're joining from, greetings for the time of the day. Good morning, good evening, good afternoon, wherever you are. I hope you're staying safe. The pandemic is not under control, and summer is over. So now we have to see how the next few months go until a vaccine comes together. So as you may have followed these sessions, we do Q&A in these sessions, and we do get lots of requests from listeners and readers on getting feedback on your particular project, on a venture that you're working on. As you know, 1 Million by 1 Million's mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. And in support of that, we do these and many other kinds of programming. One of them is our free mentoring roundtables. That is perfect for you to bring your project to. If you're looking for feedback on your project, bring your project to the 1M by 1M free mentoring roundtables. Go to 1mby1m.com and you will find free public roundtables on the top navigation bar. You'll find the entire schedule there, and you will find slots for you to book. We are doing our 500th free mentoring roundtable this Thursday morning at 8 a.m. Pacific time. So please compute what that translates into for your time zone. And if you are available, please join us. Again, to register, you would need to go to the 1mby1m.com webpage and go to free public roundtables. Over 150,000 people have participated in these sessions. It's been a regular fixture in the entrepreneurship ecosystem of the world all the way from 2008. So a long journey, and we will celebrate with a real, regular free mentoring roundtables. We will do what we do on a day-to-day basis. We will do mentoring of entrepreneurs from around the world. That's what we do. Okay, this session is going to be Q&A. We have collected questions from our various different touch points, and we're going to answer some of them one after the other. And if you have questions of your own, by all means, ask them in whichever platform you're joining from, LinkedIn, Facebook, or Twitter. Ask those questions in the comments area, in the public chat area, and I will come and answer them after the video section is over. And also, if it's a large enough question that warrants further discussion, we'll bring that into follow-on sessions and have full, comprehensive discussions on them. Okay? Let's start with our first question. Why is bootstrapping so important? Over the last decade and more, I've had the privilege of working with a large number of bootstrapped entrepreneurs. These include self-financed companies and also modestly financed companies, modestly capitalized startups that operate in a capital-efficient manner, applying the principles of bootstrapping to their financing strategy. For our Seed Capital series of podcasts and blog interviews, I've interviewed hundreds of investors, especially micro VCs and angels who are playing an important role in the early stage game. Now, a couple of pointers there actually. You can get a comprehensive overview of bootstrapping from my bootstrapping course on LinkedIn. There's a course on LinkedIn Learning called Sramana Mitra on bootstrapping. You're welcome to look at that. It's also on our blog. And The Seed Capital series of podcasts and interviews that I'm referring to are available on all podcast channels. So if you look at 1M by 1M podcast, you'll find them. And if you go to the 1mby1m.com blog, you'll find a section called Seed Capital on the left navigation bar. And there we have interviews of every single entrepreneur, every single investor that we have brought on to the series. And it's hundreds of them. So this is the supporting material that I'm drawing from in synthesizing some of the lessons of why bootstrapping is so important. Another piece that I'm drawing from is a piece called Bootstrapping to Exit that I wrote some time back, where I highlighted the importance of facilitating capital-efficient startups and smaller exits, including with small chunks of investment. In working through the current landscape of our industry, and I'm talking about the technology industry, technology and technology-enabled services only, that's the only industry we work in. Nothing that I say necessarily would apply to any other industry beyond the information technology industry. So within that scope, a few trends become evident. A large percentage of the venture capitalists are chasing unicorns. That is a fact. A second trend is too much money chasing too few deals capable of delivering hyper growth bids up valuations. So everybody wants to invest in unicorn or unicorn potential startups, and that bids up valuations. Many death by overfunding tragedies have emerged, and entrepreneurs are reacting. As Erin Griffith pointed out in her New York Times article, more startups have an unfamiliar message for venture capitalists: get lost. My observation, having covered bootstrapping for a dozen plus years, is that the industry doesn't fully understand bootstrapping. No, bootstrapping and venture capital are not necessarily mutually exclusive. The savviest and most successful entrepreneurs have bootstrapped first, raised money later. VCs love to invest in bootstrap startups that have validated and de-risked their ventures before institutional capital is invested. There is nothing wrong with that approach as long as entrepreneurs understand a few key principles. Number one, VCs come to the rescue of victory. They love to come to the rescue of victory. Number two, do not go to VCs as beggars, go as kings. Number three, excess is not a requirement for success. You don't have to build a unicorn to feel successful. You can build a sustainable, solid, profitable business, and that is success in our book. Entrepreneurship, in our definition, equals customers, revenues, and profits. Financing and exit are optional. And point number 5 is hypergrowth is not a natural phenomenon, but VCs demand it. I do not believe entrepreneurs should tell VCs to get lost. That is a wrong message. VCs are an essential part of the entrepreneurship ecosystem. And while you don't have to raise financing, if you want to raise financing, the venture option is a very good option. So this is why I think bootstrapping is really important, is that bootstrapping opens up options. You can bootstrap forever. You don't have to raise money, you can bootstrap forever. It gives you that option, and it also often gives you the option of raising money after you have validated your venture up to a point. This is why bootstrapping is such an important piece of the entrepreneurial journey, and we want you to learn all about it and the techniques and methodologies of bootstrapping as early in your entrepreneurial journey as possible. Second question, how long should you persevere on a startup before you recognize that it is not a working concept? Well, entrepreneurship is a marathon, not a sprint. An entrepreneur named Adam Singolda founded a company called Taboola in 2007. Taboola did zero revenue for the first 4 years. In year 5, Taboola did 1 million. In year 6, Taboola did 100 million. Adam persisted. He did not quit. He crossed the desert. You need that perseverance, persistence mindset to succeed in entrepreneurship. At the same time, there is also a realism angle in entrepreneurship. It is important to understand whether you are getting product market fit. And if you're not getting product market fit at the beginning of your journey, why are you not getting product market fit? Are you not getting product market fit because there's so much competition in the market and you just can't penetrate that kind of a crowded marketplace? The noise is too great. You can't cut above that noise. That's a signal that you may need to quit that venture and look at something else, another concept. A second scenario could be timing. Timing is a very, very big issue in any kind of product market fit quest. Companies that couldn't succeed at a certain time frame, 10 years later, the same concept became very successful. So the market has to be ready for what you're offering. One of the things we have seen in droves in this pandemic era is online learning, distance learning. People have embraced online learning in a way that has never been done before. And, a lot of online learning companies have seen great boosts in their product market fit and their adoption in the COVID era. Virtual events have seen incredible adoption in the COVID era. People used to love traveling, to go to conferences and have these big in-person events, and they would treat that as a mini vacation financed by the company. And in the COVID era, when travel stopped, people could not go to conferences, people could not organize conferences because large events were banned. So that's when virtual events really became the only way to communicate with customers and prospects and user groups and so on. And it became a very big trend to do virtual events. So companies that were in that business found, great success in that mode. Let's talk about a third question. How can SaaS companies with one successful product broaden their product portfolios and not become one-trick ponies? Well, SaaS companies basically start as one-trick ponies. You basically start with one company and you try to make it successful. The current market, if you look around, is full of really interesting SaaS companies that have built up to $100 million of annual revenue run rate. There's a lot. There are probably 200 companies, 300 companies in that ballpark. There are another 300-400 in the $50 million annual recurring revenue ballpark. Some have gone public, some are waiting in the wings. There are also many more that are in the 50 to 100 million range, there are lots. And then there are some who are above 200 million in annual revenue, recurring revenue. They serve different segments. Some serve verticals, some horizontal enterprise functions, some large niches, some enterprises, some mid-market, some SME. Together, the SaaS market is a healthy, robust, exciting cauldron of innovation. Unlike social media, search, or e-commerce, SaaS is not an oligopoly. And these SaaS companies that have achieved critical mass in their own segments now have an unprecedented opportunity of scaling to become much larger businesses by broadening their footprints. They can look within and look outside to identify the growth levers. Let me explain. Look within. Any company that has built a substantial business in any software category has core competency within its folds. It has highly capable engineers who have developed some degree of domain knowledge in their sphere. It has product managers who are in touch with the customers. It has sales engineers who are in regular and even closer touch with customers. It has salespeople who know the customers and the competition well. You need to establish a methodology for intrapreneurship that systematically captures the tribal knowledge that is floating in your organization. You need to proactively identify the 50 million, 100 million, 200 million blocks of opportunities that are adjacent to your current product line and line talent. Latent talent. Look outside is also important. SaaS has been the most prolific area of entrepreneurship in recent times. There are numerous SaaS companies out there. Do you have a systematic process to harness this massive body of innovation that could very well be strategically aligned with your product strategy? Which of these products should you acquire? Which of these should you invest in? Which of these should you OEM? A robust platform as a service PaaS strategy is essential to fully actualize on this opportunity. To give you an idea, the MarTech, marketing technology space within SaaS, has some 8,000 startups. So if you're a larger MarTech company, you have fertile ground to acquire from. So ideally, you want these MarTech point products that are out there trying to build companies, you want them to come into your ecosystem, integrate with your ecosystem, and ideally even kind of port their products onto your platform so that you can, essentially build on top of these companies. You can acquire them. If they're building on top of your platform, then you can acquire them and then build these companies, and they will basically help you expand your product portfolio from a one-trick pony to adjacencies. And you already have customer relationships, so it's easier to sell to the same customers additional products, so your average lifetime value of the customer goes up. So these are really important strategical elements to think through. And you also need to think this through from the point of view of the small startups. If you're one of those 8,000 startups in MarTech, you need to have a strategy on how to go about approaching this market, and how do you get into the market? How do you position? Which company's platform do you choose to integrate with? Which company's platform do you port your product to? Which company's app marketplace do you join, etc.? All of these are strategic nuances that you need to think through as a small startup trying to leverage a bigger company's channel. Why now? You may be thinking that this has been true forever in the history of software. What's the big deal now? Well, the big deal is that since 2013, every year, just in the US, 50,000 to 70,000 startups have received seed funding. SaaS has been a major category in that pool, perhaps the largest category. Currently, this number is likely increased to around 100,000, just because the amount of money in the seed market is much larger. Over 500 micro VCs have come into the market in the last 3 to 5 years. These micro VCs range in 15 million to 100 million fund sizes. However, the Series A gap continues to broaden. Only 1,200 to 1,500 companies get VC funding a year. This year, it's going to be fewer. And the metrics required for a company to qualify for a real Series A is a minimum of $1 million annual recurring revenue, often 2 million ARR. Not only that, Series A VCs want the velocity question answered before they take a leap. Is this company going to go from million to 3 million to 10 million to 25 million to 50 million to 75 million to 100 million in a 7-year timeframe? Most companies, with or without seed funding, don't get to these metrics. They may sound counterintuitive. This may sound counterintuitive, but those who do are not necessarily your best acquisition targets. As a larger company trying to acquire, you're a $100 million company, you can't really acquire another company that has barely $10 million in revenue for a $100 million valuation. The economics don't work. They may be good targets for investment alongside a Series A VC syndicate, or perhaps an OEM partnership opportunity whereby you white label their product to sell through your channel to get better ROI on your sales force. But in the other pool of tens of thousands of bootstrapped or seed-funded companies that have not cracked the velocity equation, there are rough diamonds for you to mine. Does the company have product market fit? If so, you need to take a long, hard look at why it hasn't achieved velocity. Could it be that they don't have sales DNA? Many tech entrepreneurs start from the engineering side and don't know how to build a repeatable sales process. Is that why they're not scaling? And if yes, then what can your high-performing sales force do with the product? Maybe your sales force is the answer to their velocity question. This is an excellent and very affordable acquisition opportunity for your company. You can probably acquire the company for 5 million to 15 million, depending on how far along it is. And of course, if the company is very, very early, but with a talented product team with significant insights, but struggling to finance itself, then an acqui-hire is eminently possible. This, by the way, is a global opportunity on both sides of the equation, on the buy side and on the sell side. Not just in the US, but and certainly not just in Silicon Valley, all over the world, there are SaaS companies. India especially is full of SaaS companies, and even Europe has them in plenty now. And in these emerging venture markets, exits tend to be few and far between. Entrepreneurs and investors are really hungry for exits, and their expectations are often not Silicon Valley scale. India especially has billions of dollars of capital that has been deployed into startups, and very little has come out by way of exits. You do need process to make all this work. To tap into this global opportunity fueled by a hyperactive SaaS startup trend, you need to craft precise process and methodology. At 1 million by 1 million, we have built processes. If you're interested in exploring this, if you are in a larger company, go look at Incubator in a Box from 1 million by 1 million. Go to the website and go look at Incubator in a Box. We have done both intrapreneurship challenges on Incubator in a Box and entrepreneurship challenges that are outside companies who are trying to get into the ecosystem of one of our partners. There's a lot of ad hoc efforts, but I think this is going to require a systematic execution to be able to do interesting, ecosystems around each SaaS product, so that the exit barriers out of those SaaS products broaden, and you can, if you're doing strategy for a larger SaaS company, you can broaden your portfolio out of a one-trick pony. Okay, I will do one more question. How can we increase our odds of getting into Y Combinator? I'm going to give you kind of a counterintuitive answer to this. If you want to get into Y Combinator, try to understand Y Combinator's motivation. Y Combinator is actually a small venture fund. They invest small amounts of seed money. They take equity in your venture. They behave exactly like VCs. They want to invest in validated businesses. Jas Grewal is a Y Combinator alumni that I did a case study on. Jas bootstrapped his company CareScore with a paycheck for 2 years. Jas spoke with 30 hospitals to validate his idea. CareScore had 2 customers before Jas applied to Y Combinator. So this is counterintuitive, like you're not going to Y Combinator just with a concept. You're going in there with a concept, a product, and customers. So you are fully validated at this point. While at Y Combinator, Jas did 160 customer presentations. On demo day, he raised $4.5 million in funding. If you try to apply to Y Combinator with a concept, you will not get in, because it's extremely competitive. They receive thousands and thousands of applications, and they only accept a very small number of them. If you go in with a half-baked concept also, you will probably not make enough progress to raise money on demo day. The big platform that Y Combinator offers you is demo day, where so many high-profile investors come to look at their companies. So you don't want to go up with a half-baked concept on demo day and have those investors ignore you. You want to have something compelling on demo day so that you can leverage that opportunity. So I would say the example that I just gave you, spend 2 years bootstrapping using a paycheck. Do it with 1 million by 1 million. We will help you through the incubation acceleration phase, the validation phase, and so forth. And you will not part with any equity in 1 million by 1 million. Validate, generate traction, get paying customers, and get the whole thing baked up, and then apply to Y Combinator. 1, you will get in. 2, you will be able to leverage demo day really effectively. Your probability of fundraising will be way, way above average. Okay, I'm going to go to our last question, which is one that I always address. The question is, how do we get feedback from you on my project? Well, the best thing would be to come to one of our free mentoring sessions. If you go to 1mby1m.com, and on the top navigation bar, there are free public roundtables. We offer free online mentoring roundtables for entrepreneurs looking to discuss positioning, financing, and all other strategic aspects of building a startup venture. Up to 5 entrepreneurs who registered to pitch will be able to present their businesses. They will gain straightforward feedback, advice on next steps, and answers to questions from me and possibly one of my frequent guests, CEOs and VCs who are often at the sessions. So go register, go look at the schedule. This week, this Thursday is our 500th roundtable. It's a milestone event. We would be delighted if you can make it, join us, and we will have a chance to get acquainted. These are great networking sessions as well, by the way. So that is all for today. I wish you all the best in making lots of progress with your ventures. And I will see you either Thursday at the 500th roundtable on WebEx, or I will see you next week at one of these sessions. Thank you for coming today. Bye-bye.